The so-called Amazon killer company Shopify, ticker SHOP, is up more than 20% in the last few days, like it is 2021 all over again. What did the company share in its latest earnings report that has investors piling up shares, and is it too late to get in on the action? Let's talk about that. I'm Hoda Mehr, founder and CEO of StockCard, and in this channel I share detailed fundamental analysis and interesting investment stories. Shopify's story and success in the stock market are indeed fascinating. Founder and CEO Tobias Lütke started his journey to entrepreneurship from a snowboard online store to a $70 billion company that is today. Shopify is more than an online store platform. It enables businesses and business owners to run their entire online commerce business on Shopify. From accepting payments to shipping orders to getting loans, Shopify does it all. That's why some call it an Amazon killer. If Amazon created the everything store, Shopify would make everyone an online store owner. But killing a giant like Amazon isn't an easy task. Building the infrastructure required to accomplish such a lofty goal requires lots of capital, patience, and sustained periods of unprofitability. It's no wonder that the stock price has been so volatile. The stock price has gone from $160 per share at the end of October 2021 to $27 in August 2022, experiencing more than 80% drop in less than a year. And then from there, the stock price gradually clawed its way back up with a 23% jump this last Thursday, followed by another 7% jump on Friday when I'm recording this episode. It's only natural to look at the double-digit growth in 1 or 2 days and wonder whether you've missed the boat on Shopify's recovery. Even more importantly, is it reasonable to assume that the stock price can ever return to its all-time high or even higher? Let's dig into Shopify's earnings report and see what clues the management team has left us. By the way, I own shares of Shopify indirectly through significant investment in ARK Invest's flagship ETF, ARKK, which has 11% of its fund allocated to the stock. On any company's stock card, you can get the list of ETFs that hold that stock in their top 25 holdings. This information can give you a sense of professional investors' confidence in a particular stock. In the case of Shopify, aside from Cathie Wood, who holds Shopify in several of ARK Invest ETFs, other innovation-focused ETFs, such as Franklin Templeton's Disruptive Commerce ETF, ticker BUYZ, holds the shares too. Let's start our fundamental research by recapping the latest earnings report. The most important update from the latest earnings report is the company's divestiture of its logistic business. This is a part of the company's operations that enables Shopify customers to deliver their products to the doorstep of their own customers. The company is selling this part of its business to Flexport, a logistic company, in exchange for 13% equity ownership in that company. Flexport is a private company we can't invest in, but I wish we could have. These types of businesses are typically very stable and profitable. Anyhow, back to Shopify. It won't lose its logistic operations. Flexport stays a preferred logistic partner, but the move makes Shopify focused on its core profitable software business. This is a good move, preventing Shopify from significant capital expenditure in physical shipping and logistics. It's also another good sign and an indicator of management's ability to move fast. Shopify acquired Deliverr in 2022 to strengthen its logistic business, but in less than a year, it has decided to leave that business. I interpret that as the management's ability and courage to move fast if its earlier decisions wasn't panning out as planned. Aside from the logistic business, Shopify reported a 25% revenue growth in Q1, higher than forecast. Even more impressively is the improvement in a Shopify-specific metric, attach rate. The attach rate is calculated by dividing revenue by gross merchandise volume, or GMV. Because Shopify is in a retail business, the value of the merchandise sold through its platform isn't equal to its revenue. However, the company wants to transform a bigger portion of that GMV into its own revenue. For Shopify in Q1 2023, that rate was more than 3%, up from 2.79% in 2022. This means Shopify customers use more of Shopify's systems and solutions to run their business, attaching their success to Shopify. A good example is the growing volume of Shopify payments. So the top line is growing nicely for Shopify. What about the bottom line? Analysts were worried about losses and negative free cash flow in the last quarterly earnings report. I reviewed that earnings call back then, and now I clearly remember Shopify management scoffing over the analysts' comments and saying that returning to positive free cash flow and profitability isn't a problem for a company. I leave a link to that video in the show notes if you want to go back and listen to it. The good news is that Shopify made good on its promise and generated $86 million in free cash flow, up from negative free cash flow of $41 million last year. Even more impressive is the management's forecast of free cash flow profitability for each quarter of 2023. Wow, they are giving the analysts and shareholders what they like to see. Aside from the top and bottom lines, the company's solid balance sheet is the next important factor. Shopify has nearly $6 billion in cash and cash equivalent against $1.6 billion in liabilities. So even if it isn't profitable for a while, it has the cash to allocate to its future growth. So what are some risks associated with Shopify? When a company is doing this well, investors take note. At a 13 times price to sales ratio, investors expect Shopify to become 13 times bigger from here. And that's a high expectation to live up to. Shopify is a $70 billion company. A 13 times growth means almost $900 billion in market cap, 90% of Amazon's current $1 trillion market cap. And Amazon has a profitable AWS and a growing advertising business above and beyond its e-commerce. So Shopify isn't cheap stock by no means, even if at its current price of $61 per share, 60% lower than its all-time high of $160 per share. The other thing that makes me think twice before investing in Shopify is the mention of ChatGPT in their earnings report. The company talks about integrating ChatGPT AI capabilities into its product. There's no reason for a company as focused as Shopify to run after the hype. Maybe I'm too critical here, and Shopify has to say something about AI because of investors' interest, but I don't like when companies chasing hype. As a side note, if you are interested in AI stocks, you can type artificial intelligence in the search bar on a stock card and get a list of AI stocks. You can also use it to screen stocks. For example, if you can open up the stock screener and put artificial intelligence in the theme filter, you can combine that with other filters such as undervalued stocks. getting a list of undervalued AI stocks, if such a thing exists these days. I leave a link to the undervalued AI stocks screener in the show notes for you to copy it to your own StockCard account. Another risk is Shopify's growing R&D expenses. While the company is free cash flow positive, its operations aren't profitable, partially due to a significant increase in research and development expenses. This means the company is still building its product, and that's a risk we shouldn't forget. Lastly, we can't ignore the risk in Shopify's plan to increase its subscription prices in the coming months. On the surface, that's a good thing, more revenue for Shopify. But what if customers do not want to pay the higher prices and stop their subscription? That would be a good test to confirm whether Shopify has price power over its customers. If customers don't churn in the face of price increases, it means they deem their success to be reliant on Shopify, and that strengthens Shopify's competitive moat, so critical for its long-term success. So let's recap Shopify's fundamental analysis. Revenue is growing, the company is unprofitable, and it's increasing R&D expenses drastically. It has a solid balance sheet with significant cash and no liability concerns. It generates free cash flow. It is priced quite expensively using a price to sales valuation ratio, and the management is showing solid signs of leadership with difficult decisions such as backing out of the logistics business. Knowing all that, what should we do with the shares? Have we lost the chance to get in at a good price? Without a doubt, if you are an investor in solid companies for the long run, you should always have Shopify on your watch list for picking up shares when it hits lower valuation multiples like what we saw in October 2022. You can own shares of Shopify indirectly through an investment in an ETF that is betting big on the company like ARKK or one of the ETFs in that family of ETFs. That's what I am doing. Because even if the ETF is wrong about Shopify, there are still other companies to compensate for that mistake in the long run. This allows me to keep cash for those smaller potential 100-bagger stocks I'm always keeping my eyes open for. Those are the two things I would do. But certainly we have seen the market capability to get exuberant about companies that keep on growing and also generating cash. Shopify is indeed one such company that can potentially excite investors well above the normal realms of valuation logic. You haven't yet missed the boat if you believe that. Just expect a massive price swing possibility. The higher the valuation, the harder the fall with even small bad news. Now look up Shopify's stock card to start your own research and share your thoughts in the comments so we can all learn from each other. The link to the Shopify's stock card, AI stocks, undervalued AI stocks, and the last Shopify earnings review video are in the show notes for your education and entertainment. I'll see you next time.